From shifting market dynamics to disruptive innovations, many businesses have struggled to maintain financial good standing amidst the challenges of staying profitable, sustaining growth, and navigating uncertainties in the market. Get ready to be inspired and enlightened as we dive into the heart of corporate restructuring, catalysts, and motivations for transformation. Keep watching. A brand new episode of You and Your Money starts now.
You and Your Money is brought to you by HLB Bahamas and CIBC First Caribbean Bank.
Our clients come to us because they know the level of work and the level of service that they're going to get. They know that they're going to get their work on time. They know that the price point is going to be better than the competitor, and they like the relationship that they have with us. And so because they have that level of comfort, they would call on us to help them through the next phase of their business.
My digital bank is CIBC First Caribbean. There are so many reasons why. Direct banking is totally free. I can make transfers to both local and overseas accounts all on my own. I can pay bills the convenient way, online and not in-line. I know I can trust my digital bank because their technology and processes are secure. I can use First Insights to manage my money with personalized financial advice. I love the smart ABMs. They give instant credit for cash deposits. I get extra benefits from using my rewards. That's why I choose CIBC First Caribbean as my digital bank. What about you?
Welcome to You and Your Money, everyone. Joining us today to talk about corporate restructuring, catalysts, and motivations for transformation, and more specifically, operational and financial perspectives, are representatives from HLB Bahamas, including Managing Partner, Mr. Philip Galanis, and Audit Partner, Shoneva Abraham. Shoneva and Philip, welcome to the show.
Thank you very much. It's a pleasure to be here.
Thank you for having us.
Now, I want to get us started in asking the question, what is corporate restructuring?
Corporate restructuring is the reorganizing of a company. There are various aspects that are considered and assessed in order to improve the efficiency of the company's operations, as well as to improve the overall bottom line of the entity. When we assess a company, we typically look at two key elements: the operations of the entity, as well as the financial profitability of the entity. From an operational perspective, we would assess the company in order to ensure that all of the processes that are employed in the business, it is fully maximizing all of the resources of the business, albeit the equipment that may be in use, technology, and also the employees and the staff. The goal is to operate and to function at optimum. The other aspect that we look at is the finances of the business. We assess the debt that the entity may have with banks, with creditors, and with any other institution that the company may have monies owing to.
Well, it's definitely good to know that you take a good look at the operational as well as the financial aspects of the business before you go ahead and, make any recommendations. Now, what I want to know is, Philip, can you tell us how can organizations assess the benefits of outsourcing versus employee considerations during operational restructuring?
Companies need to understand essentially why it is they're looking to restructure. Is it for operational efficiency, or is it for financial stability or financial efficacy? If a company is, for example, looking to improve its bottom line, it might seek outside assistance by outsourcing some of those services. If on the other hand, it's a question of looking at the operations of the company, it might change its focus and go and look to the people who are inside the organization to affect the restructuring. Much depends on the objective of the restructuring. That is really critical to the determination of assessing why, when, and how a company should restructure.
Now, you made mention of the objective of the restructuring. Shoneva, can you add or tell us why do companies restructure themselves and what it is that you typically find?
Companies restructure in order to ensure that they are operating efficiently, and moreover, they are looking to improve the bottom line of the company. So you may have a business that is, the turnover may be good, but the expenses may be exorbitant. And that may come as a result of them not being efficient from an operational perspective. For instance, they may be using old equipment or old technology, which is actually costing the business. With the use of technology, a company can propel their business even further. And there may be instances where the company has a desire to improve its operations, but may not be able to inject the required funds in order to make full use of the technology. And as a result, they may seek financing through the banks in order to be able to purchase additional equipment or purchase additional modifications in the software or the programs that they use in order to operate their business.
We should also keep in mind that business is constantly dynamic. The economy is dynamic and businesses change from time to time. And there is a situation or circumstances in the Bahamas today where old moneyed families established their operations many years ago. None of their children or descendants want to take over the business. Some of them wish to retire. The founders wish to retire. And therefore they determined that, okay, we're going to restructure the company in such a way that's going to either provide continuity of the business, or we may want to restructure the company in a completely different fashion. In addition to that, there is the possibility that companies might wish to expand their market share or change their product line. That also sometimes causes them to look at restructuring themselves. And then finally, the final example or circumstances surrounding a company restructuring is because it may decide that it wishes to go public. It might wish to offer its shares to the public, or you may have a situation where the existing shareholders do not get along well with each other, and some wish to dispose of their shares. Others wish to, those who want to remain in the company determine that they have to find a way to purchase the shares of the outgoing shareholders. And so all of these things come to bear on the restructuring exercise.
And would you say that this is why you would find that, or this would be the motivation for companies to voluntarily restructure?
Yeah, that's, I think, a very good reason for companies to voluntarily restructure. One, as I said before, they recognize that they are operating in a changing and dynamic economic environment. Two, they wish to expand their product line. They wish to increase market share. They might wish to dispose of some of the shares by some of the shareholders. And these are all reasons that impact the restructuring exercise.
One of the reasons why companies may also look to restructure is because they want to expand outside of the Bahamas. There is a wider global community, and having the ability to sell services and even to sell products overseas, it allows the company an opportunity to capture more of what's out there in terms of not just looking to the Bahamas for their base.
I like that you actually talked about the opportunities that exist beyond the borders of the Bahamas, because sometimes we limit ourselves to what it is that we have locally when there are options for us to expand. We have to take a quick break. When we come back, we will be looking at the financing and steps involved in corporate restructuring. This is You and Your Money. We'll be right back.
My digital bank is CIBC First Caribbean. There are so many reasons why. Direct banking is totally free. I can make transfers to both local and overseas accounts all on my own. I can pay bills the convenient way, online and not in line. I know I can trust my digital bank because their technology and processes are secure. I can use First Insights to manage my money with personalized financial advice. I love the smart ABMs. They give instant credit for cash deposits. I get extra benefits from using my rewards. That's why I choose CIBC First Caribbean as my digital bank. What about you?
The HLB advantage, of course, is one, experience. We have more than 100 years of experience if you combine the number of years that the people in that division have worked in corporate services. We have got a plethora of highly qualified professionals, whether they're lawyers, accountants, financial corporate service providers, and other service providers in this space.
Welcome back to You and Your Money. In the first segment, we talked with representatives from HLB Bahamas about operational and financial perspectives relating to corporate restructures. We're continuing our discussion, and in this segment, we'll be speaking with representatives from CIBC First Caribbean, Carolyn Roberts and Deidre Braynen from Corporate and Investment Banking. Carolyn and Deidre, welcome to the show.
Thank you for having us.
Thank you for having us.
Deidre, tell us, what are the specific steps involved in financing corporate restructuring?
The steps involved in financing corporate restructuring is basically us looking at the foundation of the business from a holistic approach. We tend to look at the financial ability of the business, in terms of what are the income streams, what are your expenses, is there ability to finance the debt? We also look at cash flow projections with strong assumptions. Let's say, you give me your forecast for the next 3 years. This is what you think the business will do or how the business will perform. We'd like to see strong assumptions. If it's a seasonal business, we want to see the peak in that, in the cash flow statements or the projections that say we know, during this time of the year, business slows down. We also look at the debt to equity mix in terms of, can the company take on additional debt? Are the shareholders invested? Are they involved? Are they just as committed as they would like, the bank to be? We look at the collateral quality. We don't take collateral as it is. You may have a building and it's appraised at X value. We're definitely going to margin that 65, maybe 70%, depending on the location. Is it prime location? Is it a specific building used for a niche, niche product marketing or something along those lines? So we're going to weigh all of those things. And if it's cash, definitely you get full value for cash. But we look at the strength of the collateral that you're offering. We also look at the management team. How strong is the management team? How long have they been in place? How is the objectives that they set, are they met? Is there succession in place? Do we have a strong man? If there's a key man or a strong man that is pretty much setting all the goals and objectives for the business, is there training in place to bring in a succession should something happen to that individual? In the case of mergers and acquisitions, we look at all of those things as well as competition, and we want to look at the synchronicity of the cultures of the target as well as the acquiring business. So we want to take a holistic approach to understanding the business when we look at corporate finance.
Now, Carolyn, I want to know, how would the bank finance a corporate restructuring?
Okay, thank you, Ria. Well, first of all, Ria, I want to say that the bank is interested in helping all of its clients, whether it be a voluntary or involuntary restructure. There are a number of ways we structure transactions to benefit both the bank and our clients. We can look at maybe putting our clients, for example, on an interest-only period during a restructure. And this is to allow for cash flows in order to continue operations. We can also look at the amortization of the facility. And when I say amortization, we can look at the interest rates that we're offering. Maybe we can, provide a palatable interest rate for the client, as well as an interest rate, of course, that provides us with a good return. We can look at maybe even extending the facility. Our normal terms are, if real estate is involved in the transaction, maybe a 15-year term. We can look in some instances of extending that maybe to a 20-year term to give the client more flexibility. And then also, depending on the size of the facility that we're looking at, we can also go to market and look at syndicated partners or maybe a club transaction. That is where we have more than one banks involved in a transaction, depending on the risk that they would like to bear on their balance sheet. And so all of these come together in terms of us trying to determine a structure that would meet the client's need as well as the bank's needs.
Now, Carolyn, you talked about, or you made mention of, involuntary restructuring. Give us a little more insight into what is involuntary restructuring from a banking perspective.
Involuntary restructuring from a banking perspective is pretty much, I would say, simple in the sense that we look at it from the perspective of a client being in a position where they're unable to meet their principal and interest payments, or in short, payments. We are regulated by the Central Bank of the Bahamas, and there are certain guidelines of when an asset is impaired that we may look at. And we have key triggers or key indicators that we look at to see when the borrower is trending in this path. Some of the key triggers may include where the client's facility on our books is running delinquent 90 days or over. There are annual reviews that we are mandated to complete on all clients' facilities, and we notice that there are challenges with providing those quarterly or annual financial reports in order for us to assess the performance of the business to see whether there are challenges. Then we may have situations where we may have an overdraft facility, and we may notice that that overdraft facility is locked in. We call it locked in the bank, but what it means is it's not turning over. There's not sufficient deposits to continually cause the account to circle in and out of credit. And then there are instances where they may be struggling to pay their annual insurance premiums on annual insurance. They may be struggling to pay real property taxes. So all of these are some of the indicators that we look at when we are looking at our clients to see how can we assist them with the continuance of their business, and also make sure that we are keeping the assets on our books intact.
Well, that's definitely good to know. Deidre, is there anything else that you want to add as relates to if there are any other triggers that indicate that a restructured asset is returning to performing status?
Performing status is pretty much the client's ability to resume principal and interest payments in a timely manner. What we would have seen our clients exhibit, that would have come from an impaired asset and returned to a performing status, what we would have witnessed with our clients is, again, a strong management team that just was not afraid to make the difficult decisions in terms of reducing expenses, cutting costs. And, in some cases, this may have led to downsizing or just job cuts for individuals. Sure, it would be a difficult decision, but the decision nonetheless had to be made to allow the business to remain a going concern. We've seen marketing strategies in terms of differentiating their products or trying to become a low cost leader, and or negotiating with your supply chain so that you now pretty much have the monopoly on a particular brand or something of that sense. We've also seen our customers pretty much stay in regular contact with the bank as well. They're letting us know what's happening with the business. This is what we're doing. We want to keep you involved because we want this asset to return to performing status. And so for us, those would be some of the key metrics that we would have seen our customers display that pretty much returned to a performing status over time.
And Rhea, also want to add to what Deidre said. What we've also witnessed is a lot of our clients have made arrangements with their creditors to allow for flexible payment terms. I think this was also alluded to by HLB Bahamas. And so this is one of the mechanisms that also allows a company to return to profitability as they restructure.
Well, you definitely gave a good indication as to, the possibilities that do exist and the opportunities that do exist with companies being able to bring themselves back to performing status. So, Deidre, thank you so much for coming on the show today.
Thank you for having me. And I also want to just put out there that returning to performance status is achievable post-restructuring. So if a client is out there and, they've been in this situation, it's achievable. Speak with your banker. It's important.
All right. Well, Carolyn, we have to take another break. And when we get back, we'll continue to talk about the drivers of corporate restructuring. This is You and Your Money. We'll be right back.
Our clients come to us because they know the level of work and the level of service that they're going to get. They know that they're going to get their work on time. They know that the price point is going to be better than the competitor, and they like the relationship that they have with us. And so because they have that level of comfort, they would call on us to help them through the next phase of their business.
My digital bank is CIBC First Caribbean. There are so many reasons why. Direct banking is totally free. I can make transfers to both local and overseas accounts all on my own. I can pay bills the convenient way, online and not in-line. I know I can trust my digital bank because their technology and processes are secure. I can use First Insights to manage my money with personalized financial advice. I love the smart ABMs. They give instant credit for cash deposits. I get extra benefits from using my rewards. That's why I choose CIBC First Caribbean as my digital bank. What about you?
Welcome back to You and Your Money. Our guests from HLB Bahamas and CIBC First Caribbean Bank are still with us. In the previous segments, we spoke about operational and financial perspectives, along with financing and steps involved in corporate restructuring. In this segment, I want to talk to Philip and Carolyn about drivers of corporate restructuring. Carolyn, what are the key factors that drive companies to pursue corporate restructuring initiatives?
Maria, based on what we've seen, trends we've seen in the market, companies restructure in order to grow market share, for technological advancements, to gain from economies of scales, also to just remain competitive. So these are some of the key drivers we think that we've seen why companies choose to restructure.
There's also the component associated with succession planning. There are some businesses for which the business owners are getting up in age, and they find that their children or the children do not wish to take over the business, and so they have sought to expand, to continue the business by ensuring that there is some level of succession planning, and so that's also a driver.
Now, Philip, I want you to continue on just by answering or letting us know, how do the market dynamics and disruptive innovations act as catalysts for corporate restructuring?
That's a very good question, because it's such a real thing. It's such a real situation. The dynamics of business today has become so much more complex and much faster moving. The accelerated pace at which business is moving has really been a catalyst for companies to assess where they are and to determine where they wish to go. In addition to which, they want to be able to position themselves in the right place. They want to right size, they want to be in the right market, they want to sometimes redefine the market they're in, and they want to increase market share, or they might wish to expand their product lines or service lines. And so all of these factors impact the corporate restructuring decision. And because business is moving as quickly as it is, because it's become more sophisticated, it's become so much more dynamic, it's caused companies to move in a way that where they're constantly reassessing where they are and where they want to be.
There's nothing wrong with reassessing. Now, Carolyn, in what ways do mergers, acquisitions, and initial public offerings influence the motivations behind corporate restructuring?
Okay, so Ria, as I think of it, I would say mergers and acquisition and initial public offerings play a key role in restructuring. For example, in mergers and acquisition, you may have an acquirer that has a stronger balance sheet, income statement, and so they may be able to provide the financial capability to assist with debt service as opposed to maybe just a single company. And so once they merge, we would look at the financial performance of both entities, which would give us bankers more comfort in terms of, underwriting the transactions. And then in terms of the initial public offering, what that does is provide cash flows for the company that's obviously raised in the public domain. But again, it would reduce the level of debt that the company may be looking to the bank for in terms of financing. And also with initial public offerings, some of the requirements may not be as stringent as a bank requirements for financing. So this would assist the company to obtain financing for its venture via both public offering as well as a debt mix.
When you get involved in initial public offerings, companies have to make a determination as to whether or not they want to incur the enormous cost of regulation. There's a regulatory cost associated with being a publicly held company, or to have an initial public offering, or to have subsequent offerings to raise money. And so companies have to make a strategic decision as to whether or not it's the best way to go. They need to determine whether or not it's the most cost-effective way to go, or whether or not the traditional bank financing through credit facilities is really the better way to proceed.
Well, you definitely, both Philip and Carolyn, you gave us a whole lot of food for thought as it relates to corporate restructuring. Philip and Carolyn, thank you so much for joining me on the show today.
Thank you very much. It's a pleasure to be here.
From operational efficiency and financial soundness to market dynamics and disruptive innovations, we've unraveled the motivations that propel businesses towards successful restructuring. As we conclude this enlightening exploration, let us remember that corporate restructuring represents not just a response to challenges, but a strategic endeavor to seize opportunities, adapt to change, and pave the way for a thriving and resilient future. But just before we go, Carolyn and Philip, please let the viewers know how they can get in contact with you.
Well, we are located on Shirley Street, CIBC First Caribbean, first floor, corporate investment banking. I can be reached at 242-356-1716. Deidre, my colleague, can be reached at 242-356-1765. But in addition to Deidre and I, we also have a strong team in place to assist with financing all of your needs.
HLB Bahamas is a full-service financial and corporate service provider. We provide audits, accounting, and consulting services, advisory services to a wide range of clients, both domestically and internationally. We can be reached at Caves Village, and our telephone number is area code 242-327-0689. We have 4 partners here in New Providence. We have an office in Freeport, and I'm certain that the specialists in the respective areas of audit, accounting and tax, advisory, and corporate services will be able to satisfy many of your corporate needs.
All right, well, that's it for today's show. Don't forget to follow You and Your Money on Facebook and tune in next week for a brand new episode. I'm Ria Christina. Thanks for watching, and I'll see you next time.
You and Your Money was brought to you by HLB Bahamas and CIBC First Caribbean Bank.